If you're a renter in Vancouver, you're probably celebrating. For the first time in a decade, the leverage has shifted in your favor. Rental rates have dropped for 22 straight months. They're down 7.5% in the last year alone and 13% since the peak. Vacancy rates are at a 30-year high, and now it's the landlords that are doing the chasing. And on top of this, there is a record amount of purpose-built rentals under construction that are all but guaranteed to push rental rates down even further. But while this looks like a win on the surface, what's happening underneath is much more profound and potentially dangerous. Let's have a look at the big winners and the big losers of this monumental shift. Anyone who owns a rental unit in BC, or anyone who's looked for a rental unit over the last year, has unquestionably noticed a decrease in rental rates. Some of the standout areas include Central Surrey that have seen about a 30% decline. Downtown Vancouver down 15%, and Kitsilano down 10%. The supply and demand curve has shifted notably in the last year. Population growth has gone negative in BC for the first time in history, obviously contributing to a reduced demand. We're experiencing higher youth unemployment and slow wage growth, which are forcing young professionals into either co-living or even moving back with parents or staying with parents longer, which is further drawing up demand, especially for those studios and one-bedroom rental units. On the supply side, we're experiencing an ever-increasing amount of rental units becoming available, from Airbnb units converting into long-term rentals to that dramatically increased amount of purpose-built rentals completing, which are really feeding into supply. In 2025, there were 22,550 purpose-built rental units that came online in British Columbia. That's a massive 28% increase from 2024. Take a look at this. When we compare the amount of rental units under construction relative to the annual population growth, this line goes absolutely parabolic in 2025. Seeing this, some would say we're currently overbuilding rental units. With rental rates already down 13% and this massive supply wall coming, the question becomes, how much lower will rents go? We look again to supply and demand to help answer that question. Because right now in BC, there was a record amount of purpose-built rentals under construction. In fact, it is 16% of the entire rental stock available. That is the highest in the country. In 2026, we can expect around 21,000 to 23,000 of those to complete and enter into the total amount of rental supply available on the market. On the demand side, let's look at population growth targets. The government released their new permanent residence target for 2026 at 380,000, but keep in mind, most of those already live in the country. International students are capped at 155,000 for this year, and new temporary workers, well, they're capped at 230,000. Now, keep in mind, we just came off of a Q3 report that showed a negative population growth in Canada of 73,000 people. We're also seeing an increase in the amount of people leaving the province, the emigration. Now, there will be some natural population growth, of course, but altogether, forecasts are predicting somewhere between minimal to maybe zero population growth for BC in all of 2026. When we combine the potential for no population growth and put that up against the record amount of purpose-built rentals coming to the marketplace, it's pretty obvious that rental rates will continue their downward trend. So who are the ultimate winners in this scenario and who are the ultimate losers? Well, the downstream effects may be more profound than you think. 2026 estimates for Greater Vancouver rental rates show as much as an additional 8% decrease by the end of the year. This would bring rents down about 22% from the peak and take a one-bedroom downtown condo on average of about $2,300 a month today down to about $2,115 by the end of the year. Understandably, renters are going to be the big winners in this environment. Renters will be able to negotiate lower rates or simply move to another property that does have a better rental rate. There's a good chance they'll be able to receive incentives as well. 1 month, 2 months free rent, possibly get those utilities included and so forth. But the groups that lose in this environment are a bit more abundant. There are quite a few condo owners out there who bought them as an investment. And today, they either don't like the rental rate they can get, or maybe they bought Airbnb and they're not allowed to anymore. And they find out when they rent long-term that they are too cash negative to continue renting. And so they want to sell that property. Problem is, when they go to sell, they're finding out just how hard it is today. And also probably not liking the number that it's actually worth on the market. And what happens after that? Well, they end up coming back to the rental market and adding to the supply even further. I have a colleague who runs a property management company representing a couple hundred doors in the Lower Mainland. And he says in the last couple months, 50 to 60% of his business are exactly those people. They've tried to sell their condo, didn't get either any offers or didn't like the price they got, and they've come back to him and said, hey, I got to rent regardless. He also mentioned that the people who are trying to rent right now, well, they're finding that the average days on market that rental listing sits for is 67. That essentially means you are on the market for 2 to 3 months receiving no rental income. And of course, when they finally do get that tenant, well, they're pretty much renting at a lower rate than they've seen in about 3 years. Take, for example, somebody who bought a 1-bedroom condo in 2022 for, let's say, $650,000. Against all your expenses and your rent, you basically have to put down about 50% just to be cash neutral every single month. Now, 4 years later, you flipped your tenant and trying to place a new one just to find out your rental rate's 15, 20% less than it was before. And now your pro forma, well, you're losing $500-600 a month, feeding it every month. Let's call it $6,000 a year. Ouch. I'm hearing a lot of people in this unfortunate situation today. If you want to know who's feeling it even more in this downturn, well, look to the REITs, the real estate investment trusts. These are the massive corporations that own hundreds or thousands of rental units across the Lower Mainland. When they were raising capital and greenlighting new projects back in 2021, 2022, well, they were basing those pro formas on what was once record rental rates. But fast forward to today, and all those numbers have turned downwards. The result, of course, is many of these REITs are seeing their net operating income fall well short of their projections. To rent up their buildings and try to keep them full, they often have to offer concessions like 1 month or 2 months free rent. And this is eating directly into the profits that are meant for investors. You see, REITs are legally required to pay out the majority of their taxable income to shareholders. But as rental income dips or lowers and operating costs stay high, we're seeing dividend growth slowing significantly. In fact, some analysts project REIT dividend growth will drop to just 2.8% this year, down from a 5-year average of over 8%. On top of this, most of these massive projects, well, they're built on debt. As those loans come up for renewal in 2026, REITs are facing much higher interest rates than they had in their original 2022 plans. So when you combine higher debt payments with lower rental income, their interest coverage ratios, basically their safety margin, starts to look very thin. We are already seeing the results impacting investors. A number of REITs have already started gating or restricting their dividend payouts. In September 2025, Centurion introduced a managed redemption program, which effectively gated redemptions for the first time in history. Set Capital has suspended distributions and blocked all redemptions since late 2024 to conserve cash and protect the remaining asset base. In August of 2025, Tres Capital suspended redemptions across 5 of its open-ended funds. Investors in these funds currently have no clear timeline for an exit. Starlight US Residential Fund faced such significant pressure that it did not gate, it reorganized. The fund was delisted from the TSXV in late December of last year and converted into a new limited partnership with a mandatory expiry now set for November of 2029. Any investors in that fund, well, they can't even think about accessing their money for at least another 3 years. All combined, there's an estimated 1.2 million Canadians that are being affected by these freezes. And lastly, and I think most impactfully, is the construction industry. For the first time in nearly a decade, BC contractors are more worried about finding projects than finding workers. According to the ICBA 2026 survey, 23% of BC contractors have already started or are planning layoffs this year. Nearly 1 in 5 construction companies expect a 25% decline in their volume of work in 2026 as the massive projects that launched in 2022 to 2024, they wrap up and there's going to be nothing to replace them. There are over 267,000 British Columbians who rely directly on construction for a paycheck. This shift puts an estimated 25,000 jobs at risk of elimination just this year. So while decreasing rental rates might seem like a pretty straightforward win for renters, we must also recognize that without a clear path for builders, this 2026 win could be setting the stage for an even more impactful crisis in 2027 and 2028. So what's your take? Is this just the typical cycle and this win is just a long overdue one for tenants? Or do you think it might get so severe that we might see some form of bailout from the federal government for the construction industry? Whatever happens, you can expect rental rates to continue to drop throughout 2026. So whichever side you are on, plan accordingly. Thanks so much for watching. I hope you found today's episode helpful. If you are looking at buying, selling, renting, or just curious what's going on in the marketplace, I'd love to chat. Feel free to reach out anytime. All my contact information is below. Thanks and take care.